In this video, we start incorporating journal entries. This lecture is where most students become lost, but hang with me and I'll give you a handy mnemonic for understanding and remembering the process. Let's review our accounting equation from the previous video. Recall that assets equals liabilities plus equity. Assets are the resources of a business that provide an immediate and/or a future benefit. We listed our common assets in the previous video, but once again they are commonly items like cash, equipment, land, buildings, receivables, and prepaids. Liabilities are the business's obligations to third parties. Usually this is money owed, like an account payable, but it can also be a service or good owed for an advanced payment. We'll discuss these types of liabilities in a future video. For now, just know that we record money we must pay in the future with accounts payable. Lastly, we have equity. The owner's residual claim on the company's assets after all liabilities are satisfied is equity. Equity generally consists of an owner's capital account, an owner's drawings account, and however many revenue and expense accounts the company uses. As for the topic of this video, the double entry accounting system merely means that we use a system of debits and credits to record increases and decreases to those elements from our accounting equation. When we record a single transaction, we do so via a journal entry. This is sometimes called journalizing a transaction. The journal entry records the impact of that transaction pertinent to the accounting equation elements. Our rule for recording journal entries is easy. The sum of the journal entry's debits must equal the sum of its credits. After preparing our journal entry, we post that entry to the ledger accounts identified by that entry. The ledger accounts show the cumulative balance from all journal entries recorded during the period. The activity in one's bank account serves as a good analogy for distinguishing between journal entries and ledger accounts. Imagine you have $1,200 in your checking account. Imagine you then deposit a paycheck in the amount of $250. You now have an account balance of $1,450. This deposit is like a journal entry. It's a single transaction that records the increase or impact of that deposit. The $1,450 balance is akin to the ledger account, which represents the cumulative impact of all deposits and withdrawals up to that date. Let's focus on journal entries first, then go over ledger accounts, and then we'll work through our coats and arms example. When most people think of debits and credits, they think credit means increase and debit means decrease. As an example, if you return a purchase, the sales rep may say something like, "No problem, we'll credit that amount back to your account." That interpretation is not necessarily correct. It can be true, but the opposite can also be true. Which of these scenarios applies depends on which accounts with which we're dealing. In actuality, debit just means left, and credit simply means right. Here we see an example of a journal entry for recording cash sales to our customers. The debit to cash means that we put that amount in the left column, and the credit to revenue means we put that amount in the right column. So how do we know if a debit or a credit is an increase or a decrease? Well, our general rules are as follows. Debits will increase the asset side of our equation, and credits will increase the liabilities and equity side of our equation. Remember how each journal entry must have the same total of debits and credits. The end result of that rule is that after each journal entry, the total of debit balances will equal the total of credit balances across all accounts. Reconsider that journal entry where we debited cash and credited revenue. The cash, an asset, increased as a result of this transaction, so cash received the debit. Likewise, our revenue also increased. Since revenue is an equity account, revenue gets a credit. At this point, we have 500 in debits and 500 in credits. Let's imagine that we make a credit purchase of office supplies. The company's supplies increased as a result of this transaction, and since supplies are an asset, Supplies gets a debit. We have an obligation to pay our vendor in the near future, which means we have a liability. The increase in our liabilities is recorded as a credit. So we credit accounts payable, our liability account, for credit purchases. At this point in time, we now have a total of $600 of debits and $600 in credits. We'll always have the same total of debits and credits across our accounting equation elements. Recall our four types of equity accounts. We have owner's capital, owner's drawings, revenues, and expenses. Remember that owner's capital and revenues represent inflows of assets. So as these accounts increase, equity also increases. Hence, that credit to sales revenue in the previous journal entry increased the revenue account, and therefore equity. However, also recall that owner's drawings and expenses are outflows of assets. Consequently, we're going to increase these accounts with debits. That way, when we increase either an expense or owner's drawings, the debit will decrease equity. As an example, let's say we pay $50 to repair a laptop. We're paying someone else to provide a service to us, so we have an expense. Therefore, we will increase our expense account with a debit, and that debit will decrease equity. Appropriately enough, we're paying out cash to the repair shop, so we'll decrease our assets, namely cash, with a credit. Again, because each journal entry has the same total of debits and credits, we have the same sum of debits and credits across our accounting equation elements. In this case, we have $550 of debits and $550 in credits. That's a lot of information, right? How do we remember whether we increase an account with a debit or a credit? To help, I have a handy mnemonic. First, just remember that debit means left and credit means right. Next, remember the phrase, after eating dinner, let's read comics. Assets, expenses, and drawings are all increased with debits. Liabilities, revenues, and owner's capital are all increased with credits. Next, let's examine how ledger accounts calculate each account's cumulative balance. We can represent ledger accounts using what we call a T account. Making a T account is easy, just draw an uppercase T. Let's consider the cash account for a particular business. Remember that cash is an asset, so whenever our cash increases, we post a debit, and whenever it decreases, we post a credit. Imagine that we recorded cash receipts from various transactions in the following amounts, and we recorded cash disbursements in the following amounts during that same time period. How do we calculate the balance? We sum up the total of our debits, then do the same for our credits, then take the difference. Whichever side, debit or credit, has the bigger sum takes the net. In this case, we have a total of $1,200 of debits and $650 of credits, which yields a $550 difference. We have more debits than credits, so we put that net amount on the debit side. In other words, our cash account will have a $550 debit balance. If you like, pause the video here to see if you can figure out the following account balances. Starting with accounts receivable. We have $1,300 in the debit side and $600 on the credit side, so that yields a difference of $700. We have more debits than credits, so we have a $700 debit balance. Accounts payable. We have 550 in debits, and we have 1,100 in credits. So that yields us a net amount of 550 on the credit side. Down to cash. You should have calculated 2,050 in debits and 1,300 in credits, yielding us a 750 debit balance. Finally, merchandise inventory. Merchandise inventory has 1,330 in debits and 900 in credits, which will net together to give us a $430 debit balance. Before we move on to our example, I'd like to touch upon normal balances. A normal balance is just what type of balance do we expect an account to have, a debit or a credit. An account's normal balance is going to be whichever side records its increases. That mnemonic will come in handy here. Assets, expenses, and the owner's drawing account are all increased by debits, so we expect them to normally have a debit balance. Liabilities, revenues, and the owner's capital account are all increased by credits, so we expect them to normally have a credit balance. Consider an asset like merchandise inventory. If you're not familiar with the term, merchandise is merely items a business purchases just to resell at a profit. For example, the boxes of cereal Kroger purchases from Post or Kellogg's would be classified as merchandise inventory, as would everything else available for sale in the grocery store. Whenever we purchase merchandise from our supplier, we increase it with a debit. Whenever we sell that merchandise to our customers, we decrease it with a credit. So that account should normally have a debit balance. If that account ever had a credit balance, that should tell us that something is wrong. Once our merchandise inventory reaches zero, we can't sell anymore. In an account like this, it's impossible to have more decreases than increases, so a credit balance should set off an alarm. Most likely, we recorded the credit to a wrong account, and it will need to be removed. This is not to say that an abnormal balance would never be okay. Imagine we have a debit balance in accounts payable. AP is a liability, so its normal balance is a credit. In this case, we might have overpaid our vendor, or we might have returned an item after paying off a liability. This issue might not require a correction. If we regularly make purchases from this supplier, we might just say there's no need to request that money back. We'll just treat it like an advance payment on our next purchase. Then, when we make another credit purchase for, say, $300, we'll only owe them the new AP balance of $100. Let's go back to the coats and arms example from the previous video. Before we proceed, note that the following journal entries and ledger postings are based on the very same transactions analyzed in my previous video. If you haven't already watched it, I recommend doing so before continuing. Number 1. Thaddeus invested $60,000 in cash and $25,000 of equipment to begin operations. As discussed in my previous video lecture, this transaction provides an increase in the business's cash assets, an increase in its equipment assets, and an increase in owner's equity. How will we record these increases? Pro tip: if you didn't copy down the previous mnemonic, I recommend doing so on a scratched piece of paper to which you may refer as we record these journal entries. We increase our cash asset with a debit. Increase our equipment asset with a debit as well. Increase owner's capital with a credit. Next, post to the appropriate ledger accounts. Just as in the journal entry, debits go to the left side of the T account and credits go to the right side of the T account. Cash now has a $60,000 debit balance, equipment a $25,000 debit, and owner's capital an $85,000 credit. Number 2. The company purchases land at $60,000, and a building at $160,000. CNA pays $30,000 in cash and signs a note payable for the rest. This transaction increased the company's land asset, increased its building asset, decreased its cash asset, and increased company liabilities. Increased the land with a debit of $60,000. Increased the building with a debit of $160,000. Decreased cash with a credit of $30,000. And increased notes payable with a credit of $190,000. Next, post to the ledger or their T accounts accordingly. Just as before, the amounts in the debit column go in the left side column, and the amounts in the credit column go in the right side of their respective T account column. Note how the cash balance will update after its posting. We had a $60,000 debit balance, but after booking a credit of $30,000, it now carries a $30,000 debit. Number 3. Coats and Arms purchases $10,000 of supplies on credit. This transaction increases supplies assets and increases liabilities. As a credit purchase, CNA is not paying cash now, but will do so at some point in the near future. Increase supplies with a debit. For our liabilities associated with a credit purchase, we'll use an account titled Accounts Payable, which will increase with a credit. Whenever you see or hear the term payable in an account name, know that it conveys an obligation to pay cash in the near future, which indicates that account as a liability. Next, post to their T accounts. Number 4. Thaddeus contributes his personal automobile to the company in exchange for ownership interest. The vehicle is valued at $16,000. This transaction is akin to the first one. The owner is contributing his own asset to the company, so we have an increase in assets and an increase in equity. Increase the automobile asset with a debit, and increase equity, owner's capital, with a credit. Then post to their T accounts. Note that owner's capital had an $85,000 credit balance after the previous transaction, but this additional credit brings it to a $101,000 credit. Number 5. CNA purchases $16,000 of additional equipment on credit. Another credit purchase, so we increase the company's equipment asset and increase company liabilities or obligations. Increase equipment assets with a debit and increase accounts payable with a credit. Next, post to the T accounts to update their balances. Observe how this debit to equipment increases its debit balance from $25,000 to $41,000, and the credit to accounts payable increases its $10,000 credit balance to a $26,000 credit. Number 6. CNA pays $1,800 cash to an employee. This is where most students lose their way, so give extra focus to this transaction. Here we have a decrease in our assets for cash dispersed and a decrease in equity via an expense. Remember what constitutes an expense. Whenever we consume one of our own assets or a service from a third party, we have an expense. Also remember what increases each side of the equation. The asset side is increased by debits, and the liabilities and equity side is increased by credits. By that logic, decreases on each side of the equation will be recorded by credits to assets and debits to liabilities and equity. We'll decrease our cash asset with a credit, and we'll decrease our equity with a debit. Afterwards, post to the respective ledger accounts to update their balances. If you're unsure whether to debit or credit an account, remember the mnemonic. Assets, expenses, and drawings are all increased with debits, and liabilities, revenues, and owner's capital are all increased with credits. Pay special attention to expenses here. Debiting salaries expense increased the account's balance, expense carries a debit balance which went from a zero to an $1,800 debit balance. However, since expenses are equity accounts, debits to such accounts will decrease overall equity. Number 7. CNA provides services to a client and collects $8,000 in cash. Here we have an increase in our cash asset and an increase in equity. More specifically, anytime we earn money, usually by providing goods or services to our customers, equity increases by way of a revenue. As for the journal entry, increase cash assets with a debit and increase equity with a credit. After we post our debit to cash, the balance increases to a $36,200 debit. Fees earned will carry an $8,000 credit. Number 8. CNA paid $700 for the month's utilities. This transaction yields a decrease in our cash asset. On the opposite side of the equation, we're consuming a service from an outside party, so we have a decrease in equity via an expense. Decrease cash with a credit, and decrease equity with a debit to utilities expense. I hope you picked up on how I worded that statement. Note that I didn't say decrease utilities expense with a debit. Rather, I said decrease equity with a debit to utilities expense. When we post to the T accounts, utilities expense increases from a zero balance to a $700 debit. But since expense is an equity account, this debit decreases equity. As for cash, its credit decreases its balance from $36,200 to a $35,500 debit. Number 9. CNA paid $2,000 to satisfy the obligation created in number 3. With this transaction, we're paying off an amount owed, so we have a decrease in our cash asset and a decrease in our liabilities. Decrease our cash asset with a credit, and decrease our liabilities with a debit to accounts payable. Post to the ledger accounts. Accounts payable will now have a $24,000 credit balance, and cash will decrease to $33,500. Number 10. CNA purchases $20,300 of new equipment for cash. Here we have an increase in the equipment assets acquired and a decrease in cash for the amount dispersed. Consider how we have an increase and a decrease on the same side of the equation. We still have $20,300 of assets, but now that resource is in the form of equipment in the shop as opposed to money in the bank account. We record this transaction by increasing equipment with a debit and decreasing cash with a credit. Post to the T accounts. Equipment's balance rises to a $61,300 debit, and cash decreases to a $13,200 debit. Number 11. CNA provides $6,500 of services to a client who will pay in 30 days. Whenever we earn money, especially by providing goods or services, we have an increase in equity via revenue. Revenues are always accompanied by increases in assets. CNA has a right to receive the money in a month, so the asset increasing will be accounts receivable. The revenue being used for services will be fees earned, as previously indicated. As our first entry to AR, it will carry a $6,500 debit balance. The $6,500 credit to fees earned will give that account a new credit balance of $14,500. Number 12. CNA pays $2,400 to an insurance company for a 2-year insurance contract. The cash dispersed will be a decrease in assets. You may be thinking this decrease in assets will be accompanied by a decrease in equity via an expense. Not just yet. Remember that we have an expense whenever we consume a service from another party, but we haven't actually done that as of this payment. Immediately after making this disbursement to Allstate, Geico, or whoever that insurance company may be, that company owes CNA insurance coverage for 2 years. Whenever someone owes us something, not just money, we increase an asset. This particular asset will be increased with a debit to prepaid insurance. Prepaids are the types of assets we use when we have a right to a service. Prepaid rent is another such asset that is commonly owed for advanced payments. As for cash, we decrease that with a credit. Prepaid insurance will get a $2,400 debit balance, and the credit to cash will tabulate to a $10,800 debit. Number 13. CNA pays $1,800 in cash to its employee. Here's a direct repeat of transaction 6. Decrease our cash asset and decrease equity via an expense. We decrease equity with a debit to salaries expense and decrease our cash asset with a credit. The debit to salaries expense increases that account's balance to $3,600, but as an equity account, that debit decreases overall equity. Cash's credit decreases its $10,800 debit balance to a $9,000 debit. Number 14. CNA receives $4,000 in cash owed to it by the customer in number 11. With this one, CNA is collecting at least a portion of the previously recorded AR. The cash received will increase assets, but since that AR is no longer owed as a result of this payment, CNA has a decrease in its AR asset. Increase cash with a debit, and decrease accounts receivable with a credit. The cash ledger will increase by the amount from $9,000 to $13,000. AR will decrease its debit balance from $6,500 to $2,500. Number 15. Thaddeus withdraws $2,000 from CNA for his personal use. Remember that while the owner and the business are legally one and the same, with accounting they're considered to be separate from one another. So this cash is technically leaving the company, meaning that company assets are decreasing. The decrease in assets will be accompanied by a decrease in equity via the drawings account. Cash will be decreased with a credit, and equity via the drawings account will decrease with a debit. Drawings functions just like expenses in that the debit it receives increases the account balance, but as an equity account, this debit balance decreases ownership interest. The credit to cash decreases cash from a $13,000 debit to an $11,000 debit. When all these entries are recorded and posted to the ledgers, we can list each account's debit or credit balance categorized by assets, liabilities, or equity. The sum of our asset balances total to a $323,200 debit. Liabilities and equity total to a $214,000 and a $109,200 credit balance, respectively. Note that the debit balances in expenses and drawings offset the credits in the other equity accounts, revenue, and owner's capital. This reduces our overall credit balance. Sum the two accounts together of equity and liabilities, and you have a $323,200 credit balance on the right side of the equation, which equals the debit of assets on the left. Our equation maintains its balance after every single transaction. That concludes this lecture. I should mention that I have another video series in which I demonstrate the solutions for accounting problems. If you're still confused or not fully confident, I highly recommend watching the Chapter 2 Workbook Solutions video. You don't have to watch the entire thing, but the first problem I work through will likely give you that breakthrough you need. I'll put a link below. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions for how I can improve, leave them in the comments below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting feedback from contemporaries. Thank you once again, and I'll see you in the next one.